India is halfway around the world from the U.S. Federal Reserve, and yet, like many emerging markets, the markets are pretty much hostage as to whether they're going to taper their massive stimulus or not. It's schizophrenia, isn't it, for the markets?
It's a total personality split. You can take 15 out of 30 shares out of the Sensex, the 30-share benchmark index that foreigners love to own. Infosys, TCS, those are outsourcing firms, and then HDFC Bank, ICICI Bank. These are non-state-owned lenders, and make your own free-floating market cap-weighted index. And you can show, like the team at the Mumbai-based brokerage IIFL has, that the market has actually done twice as well since its pre-financial crisis peak in January 2008 than you would think looking at the Sensex itself. Conversely, you can take the stocks that foreigners don't like to own, such as Coal India and State Bank of India, which is a state-owned lender, and show that the market has done 20% worse.
Is this set to change when we really get a sense from the Fed on tapering? Or are we still going to have this schism as foreign-like stocks and the ones they don't for some time to come?
Well, the Fed is going to be a big factor in ending this divergence one way or the other. And I say one way or the other because either the foreigners will spread their love more widely or they will leave if India-related jitters that we saw during the summer when Fed first started talking about tapering, if those jitters return.
This is like a dual economy because India's economy is suffering. Those grand days of big brick growth are behind. Surely India and its domestic economy needs to really catch up for those domestic-related stocks to do well and for foreigners to be even vaguely interested at this point.
Yes, and one big bet on that front is the election, which will be held sometime in April or May, and which will basically choose the next set of rulers in New Delhi for the next 5 years. And that's a huge political risk, but then risk cuts both ways, right? It can also make for a very nice payday for the brave-hearted. The Indian market saw some of that in 2009 when it went up 90% in just 3 months as elections took the Marxists out of the ruling coalition. Now, this time around, there's a big bet on a stable, business-friendly, reformist government. But then the beauty is that it's a pure gamble in India because you could as easily get an unstable, ragtag, revisionist coalition. This is not a market for widows and pensioners, Tara.
Absolutely. So for the brave-hearted, political risk, Fed risk, and generally growth risk. So watch out for India if you really want to get in there.